So payback period. So this is a further financial measure to judge an investment appraisal option. So in an investment appraisal essay, I would be looking at a start paragraph on net present value, a separate video on that, which hopefully you've seen. That should be just on net present value, questioning which option is better on that basis, looking at the limitations, exploring those limitations, how they affect your judgment, show off your analytical skills. If you combine net present value and payback period at the same time, you're not showing those high level skills. You're rushing it. You're going to be in that level 1, level 2, which is not where you want to be. You want to be hitting a minimum level 3, pushing yourself into 4 and 5. The way you do that is with limitations and with focused paragraphs on different points showing your skills. So payback, slightly different option. We're looking at payback. The quicker the payback, the better. So the quickest payback means we get our money back, obviously earlier than the other option. And so purely on that basis, we would say that a quicker payback is better. And then we look at the idea of liquidity, because obviously the quicker we pay back our investment, the quicker we've got the cash back, and that will improve our liquidity within the business. But then we've got to question the importance of liquidity. So sometimes in the scenario, they might reference the businesses having issues with cash flow, when clearly then payback should be a major factor when you're deciding which option is the best one. But if you're a large business, those companies like Apple who've got more money than multiple countries combined, payback period isn't going to be a major factor that would influence their investment appraisal decision. So think about that, qualify it. We've got to question everything that's there. We don't just go in a straight path. If we go in a straight path, you're not really showing that level of synthesis that we're looking at for the high level marks. Also, the size of the investment is relevant. Clearly, you've got a lot of money committed, so the quicker you get it back, the better. But a larger investment might take a little bit longer in payback, and you can build that into your analysis and say, well, is it slower? Clearly, it would be because it's a large amount of money. And you could bring in the fact that net present value is higher if that is the case then. So just because the payback is longer doesn't mean it's a problem. But we question it, we talk about it in terms of the size of the investment. But clearly, the quicker the payback, the better. What we can then say is the quicker we pay back, the quicker we can generate a profit, because anything after payback would be a profit. However, how long is this investment carrying on for after payback? Sometimes you'll gain the length of the investment and the payback. Excuse me. But that's something to factor in. So the quicker we pay back, the quicker we can make a profit. One thing I always talk about with payback period is it's definitely got an inherent bias. You can tell I'm already questioning with payback, is it important, isn't it? We're not really considering long-term projects. A project could take a lot longer time to pay back, but overall we'll make a larger profit. And if we just base it on payback period, we are putting that bias. We're focusing on short-term projects, ones that get the money back quicker. And whereas if we're a company, maybe that's the right thing, because then we can pay back to our shareholders in the form of dividends quicker. But for the long-term survival and long-term profitability of the business, it may not be the best option. So something to consider. It doesn't calculate profit, just calculates payback. So we can say it should make a profit, but it's not really telling us that. So we've got to factor that into our analysis. And we're just literally saying when we get our investment back. It doesn't consider the time value of money. So when we're judging payback period, we're saying that money in 2 years' time, 3 years' time is worth the same as money now, and that's not true. We've said that in the net present value video, and it just means that there is an inaccuracy here. So we're saying we're going to pay back in a couple of years, when realistically, we're not. It's going to be longer than the figure given because the value of money will decrease over time. So lots of limitations with the payback period to consider. One of the benefits, though, is it does focus on earlier cash flows. Now, as we said in the present value video, one of the weaknesses with net present value, it can be if it's a long-term project, the cash flows can be inaccurate over the years, whereas payback focus on the earlier cash flows, they're the easier ones to predict. You're more likely to be accurate in the short term. So this could indicate that payback period is a slightly more accurate measure because it focuses on earlier cash flows. But payback is a really good measure. Obviously, you need to use it in an investment appraisal essay and just think about it. Liquidity, consider limitations, question it, but getting a strong paragraph on it. Okay, good luck.